Hey, everybody, and welcome to Making Sense with Dustin Lamontagne from Mackey Research Capital. My name is Bryn Griffiths. Hey, Dustin, how you doing today?
Awesome, Brim. How are you?
Great, thank you. Let's talk about real estate investing on today's episode. Where do you want to dig in on that? Well, let's start with residential. I guess it only makes sense to start there.
Yeah, I mean, residential usually entails, somebody buying a property, whether it be a condo or a house or a small, maybe a duplex or a fourplex, and renting out to people and, collecting income. Pretty basic, although there's a lot you need to know. To me, I've had different properties in the past, and I know I'm certainly not cut out to be a landlord. I'm much too soft. But I tend to more focus real estate investing on the commercial side.
Is this a good time to be getting into this kind of thing? Because everybody says, well, things are flattening out a little bit, or maybe they're a little negative about things, but there's always somebody looking at residential property or commercial property.
Well, I think that, real estate investing, just like, when you buy your house for resale, it's all about location.
Oh, yeah.
And right now, the two locations that have been making money are Toronto and Vancouver. So I would probably, steer clear of those markets. I tend to think they're significantly overvalued at the present time.
They're too hot, right? Both those markets?
They're too hot, and that's a function of, too much money chasing too little inventory. And wealthy immigrants coming, primarily from Asia, and buying property. They're getting money out of Hong Kong like crazy right now.
Yep.
And that's propping up those markets.
And the BC government's trying to curtail that a little bit, right? And does it not affect everybody then?
Yeah, they've put some luxury foreign taxes on and whatnot. To me, all these initiatives are kind of hokey. At the end of the day, the market's going to do what it's going to do, and it will probably for this foreseeable future, because so much money is being made in Asia, and these wealthy people, especially in Hong Kong, Beijing, Shanghai, they want to get their money out of those countries, and they're going to keep buying property in Vancouver and Toronto. Speculation
tax, is that not the word that they use for that in British Columbia, I think? Something like that.
Yeah, and I think they're looking at the mayor of Toronto wants some help in that regard, because what's happening is they're pushing the property values up so high that your average middle-class person in Toronto now cannot afford rent in the GTA. So, and same thing in Vancouver. That's a problem. If you're a teacher and married to a firefighter, or vice versa, and you can't afford anything but a basement apartment in Burnaby,
there's something wrong there.
Something wrong with that formula, right? So, from an investment perspective, I really like real estate on the prairies right now, because our economies have been a little bit soft, and whether you look at apartment blocks in industrial properties, or even these strip malls, prices have come down significantly on commercial property on the prairies. So I think there's probably some good buying opportunities to be had, but again, it's location. I'm being an investment advisor, I've more gone towards real estate investment trusts for my client base in terms of real estate investing. And in case there's people out there that don't know what a real estate investment trust is, typically you've heard the acronym REIT. And it's basically the same as a mutual fund in the sense that a whole bunch of investors put their money into these REITs, and it allows the managers of the REIT to buy, have greater buying power. They can buy shopping malls and apartment blocks and big industrial warehouses, whereas an individual on their own could never get exposure to that type of an investment. So they're very, very slick vehicles to participate in the real estate market.
How do you keep up on all this stuff? Every time we talk, I go, wow, I just can't believe, wow, that's it's just my head spins.
Yeah, it's 2 to 3 hours of reading a day helps. But don't forget, I've been doing this.
Yes.
I'm in my 25th year in the investment industry. So I started in university, second year university, and I've never left the industry. So, getting back to REITs, if we're looking at real estate investment trust as an investment, there's some key variables that you want to consider.
Okay.
We look at what interest rates are doing, something called a cap rate, which is essentially the rate of return that you're getting off of that property. To put it in simple terms, rent divided by, rent minus expenses divided by property value. Essentially. So for different sectors, if we look at residential, industrial, retail, healthcare, et cetera, there's different cap rates that are appropriate to value those different types of properties. And then something very specific to real estate investment trust is return of capital. So you might have heard or remember the income trust boom that happened around 2005, 2006 before it had to get shut down because all these companies were turning themselves into income trusts. The basic premise of that is that you get preferential tax treatment in the form of deferred capital gains for a real estate investment trust. And this makes a lot of sense from a practical point of view because typically real estate is a long-term holding. So if you had to pay capital gains every year on the value of that property as it goes up, it wouldn't make a lot of sense to hold that investment. So essentially, when you get the income from the real estate trust, a portion of that gets paid back to you in what's called a return of capital, which bumps up your cost base, and it's just a little bit of a tax break. I won't get into the specifics of that because it's more an accounting issue. But
plus, we also want people to contact you as well. We
Yeah.
don't want to give it all away here either.
Exactly. But
Well, the other thing though is that we had gone through on the prairies in particular. Houses were going up at crazy prices, right? And now it's flattened a little bit, which might be more realistic. But are we going to see another boom like we saw before? Do you think that we're leveling off a little bit and that's going to be okay?
Well, the market in Edmonton in particular, and cities like Calgary, Winnipeg, Saskatoon, Regina, unfortunately, we're not boxed in, and the cities can just build out as far north, east, south, and west as they want because it's just all farmland. So the reason you're getting these geometric growth in cities like Toronto and Vancouver is because they're boxed in.
Yeah.
Toronto has Lake Ontario in the south, and Vancouver has the ocean and the mountains. So the only way they can build is up in Vancouver, and you're starting to get pretty far out in Toronto from being a suburbanite. You're already traveling 2 hours a day, so they're starting to build up in Toronto now too. And when you start to build skyward, of course, the land underneath those buildings becomes extremely valuable.
Yep. If you have any questions on real estate investing, make sure you give Dustin a phone call because it's always on the change. Your phone number, by the way, is
780-905-7729.
And you can be emailed at
dlamontagne@mackeyresearch.com.
It's a changing landscape, right?
Yeah, no pun intended.
Actually, you know what? And I usually am the worst pun master that there is, so I'm kind of surprised I actually threw that out and didn't even realize it. Anyway, you can also check out their website, which is mackeyresearch.com for more information. And just a reminder, the markets and financial numbers change frequently, so what we may say today could easily change by later today and overnight. Dustin, thanks for your time today, and we're back in another couple of weeks.
Thanks, Bryn.
All right.